Okay.
Hello and welcome to the Platt Institute webinar. I'm Adam Weinberg here at the Platt Institute. Today's program we have as our guest economists Ernie Goss and Scott Strain to discuss the findings in their latest report on the economic impact of COVID-19 on the Nebraska economy. I'm joined by Platt Institute Policy Director Sarah Curry, who will help facilitate the program with me. A little bit about how the Platt Institute webinar works. It's a webinar, not a meeting, so you'll only see our panelists and folks who are facilitating the program. If you'd like to participate, you can use the Q&A or the chat section to submit questions throughout the program. Our guests will be here for an hour so that they can take your questions about the findings that they're going to present in our latest paper. As you see over my shoulder here, we now have the paper up online at the Platt Institute website at plattinstitute.org/policy. And you'll also see that we already have a slate of Platt Institute webinars scheduled for the month of July. We're going to be discussing being back in session in the Nebraska Legislature as the legislature completes its final 17 days of the 2020 session. So we encourage you to sign up for those and join us at plattinstitute.org/events. Before we get started with the program, I did want to just give you one more programming note. When you want to check out what we're doing here at the Platt Institute, which we encourage you to do through all of our activities online, we are going to be launching in the days ahead a new Platt Institute website at plattinstitute.org. It's got some great features that I think will be informative and help Nebraskans engage with the public policy process. I also think it'll be easy to access information because it'll be a mobile enabled website. It's got some nice looking features, and I hope in the next few days when it launches that you get to the opportunity to enjoy it. We'd be glad to have you there and to sign up for our notices by email so you can take a look at what we're doing at plattinstitute.org. I'm going to turn that off now, and now I'm going to turn it over to Sarah, who's going to introduce today's program with economists Ernie Goss and Scott Strain. Sarah?
Thank you, Adam. And I just want to thank Dr. Goss and Mr. Strain for being here today. As you all know, we've been doing economic impact studies on COVID-19 and what that means for Nebraska, specifically businesses and tax revenues and our economy in general. And so Dr. Goss and Mr. Strain have been updating those as the unemployment numbers and the other numbers are coming out from economic sources. And so this is our third cut. And I'm going to let Dr. Goss and Mr. Strain talk through the report. And as always, we are happy to take your questions. If your question pertains to what they're talking about, we might, stop and ask that during the presentation. If not, we'll definitely leave time at the end for question and answers. And with that, I'm going to turn it over to Dr. Goss to start talking about it. And you just let me know when you want to share screen to show the visuals, Dr. Goss.
Okay, thanks, Sarah, Adam, and Scott. And if you could, and thank you for all the support from Platt Institute. And I'd like to just begin by saying this has been obviously a trying time for everybody in the nation. It's almost like a trial run for hell. It's I don't mean to, and I don't say that lightly. It's been a tough couple of months. And that's for an academic who's been able to continue to do my job without much trouble. And I'll just start off with saying I went to my dry cleaners yesterday, and they're closed 2 days a week, Wednesday and Friday. Now that was quite amazing to me, Wednesday and Friday. And the point here relative to our study is we're not picking up some of that. In other words, reduction in hours. We're not implementing or putting that into any significant degree. We are picking it up, but not really our impacts analysis is coming really significantly off of continuing claims for unemployment insurance. So Sarah, if you could bring up that first slide and we can talk about that. Just looking at this, amazing. And you see there, this is the unemployment rate for Nebraska from 1976. The latest year we have reliable numbers from the Bureau of Labor Statistics, and you see even through the 1980s when the agricultural crisis, Nebraska did not even approach 8.3%. Now this is 8.3% for April. Now I'd like to warn a lot of folks that aren't familiar with how this number is derived. This is from the Bureau of Labor Statistics. It's a survey of 60,000 households nationwide. 60,000 households nationwide, Nebraska accounts for 1.1% of the U.S. population, probably about 1.1% of the households. So you can see when you drill down to Nebraska, the margin of error gets very large out there. So that 8.3% is the midpoint of the estimated rate of unemployment. That's the first thing I'd like for everyone to be aware of. I would argue this number is not that good. Now, Scott may have a different opinion on that, but he and I have talked about it a lot. So there's a large margin of error, probably up to perhaps as high as the upper end at 10% or above 10, the lower end, of course, at about 6%. So anyway, that's the first caveat. The second caveat is that it was produced in around the second to third week of April. So it's not picking up some of the latest data that shows the impact on the labor market. And what Scott and I use, the labor markets, where we estimate our impacts. The impacts are coming based upon direct labor impacts. So that's another caveat. Is from the second to third week of April, and thus it's quite old. So we didn't use this. We use this number to validate our number, which I'm going to show you next. If you can bring up the next slide, if you would, Sarah. And here you see the continuing claims for unemployment insurance. And I'm going to bring it up on my computer here in my office there. And you'll see 61,571,000 for, that's not the right slide there. Somehow we're not there, Sarah. That's the wrong one. That's the old
Ernie,
one.
you just talk and I will bring up the right one.
Okay. We'll bring up that moment. It's the continuing claims for unemployment insurance, and it's from May the 9th. Okay, so not only several advantages to using the continuing claims for unemployment insurance. First, it's not a sample, so there is no margin of error. Secondly, it's much later. It's May the 9th, and you see there, it's Nebraska. The latest number is 61,571 for the state of Nebraska. U.S. number is 22,942,103. So you see the difference there. And the beauty of this is, if there is any beauty in this analysis or what's going on, is it's declining in Nebraska. You see there it's declined for the last 3 weeks. And this is the week ending May the 9th. Now we'll have to wait and see when we get the numbers. They'll come out every Thursday. So another beauty of this statistic that we're using, again, one of the beauties is it's not a sample. It's actually a census. There is no margin of error. Secondly, it comes out every Thursday. And thirdly, it's a better measure of what's going on in Nebraska. This is a Nebraska number, not a number that's derived from any sampling from the Bureau of Labor Statistics. So you see there again, the number's coming down, the continuing claims, but you see where it began from. Look at this from March. So you see around the 14th to the 21st, if you can look at that, you see where the COVID virus, COVID-19, really began to have some negative impacts. Now these are not seasonally adjusted. That is somewhat of an issue, but it's not much of an issue for Nebraska. The seasonally adjusted will be pretty close to the not seasonally adjusted. Now we're using the not seasonally adjusted simply because it's more timely, and again, doesn't deviate significantly from seasonally adjusted. But again, this is look at this, 61,571 versus what we had here before the impacts of the COVID-19, and we're down to probably, I've forgotten the number, but I think 3,000 or 4,000. I believe that number is correct. So if we can move to the next slide, please, Sarah. And here you see, now this is the insured unemployment rate. So, okay, the insured unemployment rate there, and you see Nebraska has one of the lowest in the nation at 7.1%. Now that's not seasonally adjusted as well. But again, that's well up from what we recorded, Nebraska recorded, before COVID-19. So 7.1, it's likely to continue to increase even though the continuing claims for unemployment insurance are coming down. I think that rate will probably continue to go up. That's in my judgment. But you see how Nebraska ranks among the nations. Nevada, number 1, they're the highest rate in the nation at 23.5. Now, why is Nevada high? Well, of course, it's because the industry Nevada specializes in, leisure and hospitality, is an industry that's impacted the most. Now, I'd like to discuss a little bit off the topic, but central to this, Creighton, we do 2 surveys at Creighton University each month. The Mid-American survey, the results were released yesterday, and that's a survey of manufacturing supply managers. That number was up a bit, but still in recession range. The survey of manufacturing. Manufacturing has not been as hard hit as those industries related to the consumer. So the consumer industries, those that depend on spending by the consumer, have been hit very hard. For example, going to a movie, getting your hair cut, personal services, even professional business services to some degree being hit hard. So that's one survey that came out yesterday from Creighton. Our other survey comes out on the 3rd Thursday of each month, and that came out a couple of weeks ago. That was for the month of May, and it was awful. The number was well below growth neutral. So what we're seeing for Nebraska is the manufacturing sector not doing as badly as the other sectors. We're seeing the rural areas being hammered now, not so much by COVID-19, although we're seeing those impacts, but also because of the agricultural sector getting hit because of exports. Our export reading for the month of May was record low. So we're seeing some really bad numbers in rural areas, even though they're not being hit by the virus directly, being hit indirectly because of the global economic slowdown. So Sarah, if we could bring up the next slide, please. And here, this is the estimated loss for the state of Nebraska between the 14th of March and the May the 9th. And I'll let Scott take over here. And Scott, if you want to discuss the impacts, the methodology that we used, and how we derived it and how we continue to derive it. We did a cut 1, and this is, of course, cut 3, I'm sorry. We did 1, 2, now 3.
Thank you, Ernie. We look at the continuing claims primarily, well, in contrast to, say, initial claims, because many times the initial claims don't follow through to someone actually being unemployed. And what we're finding out, at least anecdotally, during this period of time, is that even if someone files an initial claim, they're called back to work before the entire claim or all the paperwork's done for the claim. What we try to do with each of these cuts is use the freshest data available, back checking, like Ernie said, against some of the other data that comes out from the BLS, both state, regional, and national. And for this cut, we were able to utilize the reported unemployment rate from the BLS and compare that to the continuing claims over this 8-week period. Use the ratio between the unemployment rate reported by BLS and the actual continuing claims reported by the Department of Labor. Marry those two together, and we come up with an estimate of job losses in the state of Nebraska. Now, we apply this ratio, or take this ratio, and distribute it across industries. And the Nebraska Department of Labor has done a great job of capturing information at an industry level for people impacted during this period of time, so that we've got fairly robust results across industries. Once we have identified the industries and distributed the number of unemployed folks on the continuing claims across those industries, we can then put them into an input-output model called IMPLAN, and then run those results and come up with an estimate of jobs lost, wage and salary earnings, and self-employment income lost, in addition to the overall impact on the economy. And Sarah has a table up here, the estimated loss for the state of Nebraska. We're looking at approximately 93,000 jobs impacted during this time period. About $435 million in lost wages, about $61.7 million in proprietor or self-employment income, and about $1.5 billion of lost sales activity. That's output in the state of Nebraska over this 56-day period. Now, in addition to this, and Sarah, if you can move to the next slide, we've also made an estimate of the fiscal impact. Now, this is broken out into both state and local, the local including both metropolitan, city, town, up to the county level. So we've got local and state combined during this 56-day period, close to $80 million negative impact on tax revenue. That's about 38.3 million for the local and about 41.5 million at the state level. Now, if we annualize those figures, and Ernie alluded to this earlier, what we are not able to capture by using continuing claims are reduced hours. We're also going to be limited into having an understanding of what companies are actually going to come back to life. We're saying there are 93,000 jobs that went away. At this point in time, we don't have a reasonable estimate of how many of those jobs are going to come back and how many of them are going to come back at 40 hours a week, full-time schedule. Now, taking that into consideration, we annualized the impacts to give maybe a little bit more perspective on the coronavirus impact. Again, based on those 93,000 jobs, if it's extended over the entire year, you're looking at wage and salary losses of about $2.9 billion. Self-employment income loss of about 402 million, and the total impact is going to be north of $10 billion. And then what that means for state and local tax revenue is potentially $521 million loss. Again, this is on an annualized basis, but those are figures that we need to talk about. Ernie, I don't know if you have anything to add.
Well, and talking about, I see some of the questions, and very good questions, by the way, coming up there that I see at the bottom of the screen. And before we turn it over to questions, if we can take a few more minutes, Sarah and Adam, to just talk about the recovery. I mean, there's something going on strange out there, of course, in economic terms, and it's very difficult for economists to judge which market is getting it correctly. By that I mean, look at the equity market. Stock prices are just not down. In some cases, they're up significantly. Now, a lot of those are with good reason. For example, Zoom, this product we're using here, we can understand why it would be. But some of the others, Apple, Microsoft, and others, we understand. You can understand why some of the equity markets equity, but given the mixed messages you're getting here, that market is telling us that this economy is going to rebound soon. You look at the bond market, where yields are now at 0.7% for the 10-year bond, 10-year U.S. Treasury bond, 0.7%, 7 to 0.8%. That's telling you this is going to be hell to pay. In other words, we're going to see continuing issues with the economy. Now, who's right? Bond investors or stock investors, or is it somewhere in between? I've been quoted as saying there was initially, back in March, I think it was, I said there would be a V-shaped recovery. It's too late for a V-shaped recovery. And then I said then, and I quoted very recently in CEO magazine, I think it was, a U-shaped recovery. Not going to be a U-shaped recovery, I don't think. It's going to be a Nike swoosh, meaning sharp downward and the movement upward. This is going to take longer than we initially thought. And unfortunately, Nebraska is going to be part of that. I mean, we're talking about the global economic downturn. And yesterday, the president took a hard line with China again, saying that we're not going to allow flights in from China. Now, I'm not qualified to judge the merits of that, but I can tell you, when we start shutting ourselves down to international trade, which again, from the political point, I'm not qualified to comment on or to even discuss, I'll tell you, economically speaking, it hurts. And it hurts agriculture, and it hurts manufacturing. And and if you look at, not only does it hurt manufacturing and agriculture, and this is important for Nebraska, it hits manufacturing and agriculture, the volatility. In other words, which manufacturing? Food processing. What manufacturing does Nebraska specialize in? Food processing. Or agriculture. What agriculture? Well, obviously livestock and grain. So it's been hit and hit hard. So I don't mean to be depressing or be the gloom and doom. I'll be gloom and Scott can be doom, I guess, or we'll exchange. I don't know. And I smile, but it's nothing. And Scott and I do smile, but we try to put a happy face on some bad news. But I don't see a real recovery until probably the second half of 2021. Now, that said, and we need to issue a caveat here, we're not considering the impact of the CARES Act. And the CARES Act is the largest expansion of the deficit, U.S. federal deficit ever, the biggest stimulus from the Federal Reserve ever. So what we're going to see is some of those impacts will be reduced and be paid for later. Now, how will it be paid for? With rising inflation. When will rising inflation hit the Nebraska economy? Not until 2021, probably, when we see rising inflation, rising interest rates, and paying for it via higher taxes. Now, as Scott said, the local level, and I saw one of the questions came up already. Wait, now you said property taxes. How the heck is it going to have a negative impact on property taxes? Well, if the CARES Act does provide support through local governments, you could have some of that diminished. Now we don't know just yet, but that reflects the reduction in assessments. Now, those of you who are on this webinar know what's the probability of that. Well, it also reflects the reduced construction activity and the property taxes on that construction activity. So, and finally, I'd like to say the recovery will be delayed, has been delayed by the foolishness around some of the measures of the CARES Act. Now, what do I mean by that? Paying somebody $600 a week more above their normal unemployment compensation. Now, I'm not arguing they are not entitled. I'm not saying that. They are perhaps entitled. But who's the fool who's going to go back to work when you can make more unemployed than you make working? So, so if that's extended, now that ends at the end of August. At the end of August, we're going to see some upturns in employment if there's no extension to that $600 a week support. And go out there and talk to a lot of restaurants. A lot of the restaurant owners I've talked to a lot have said they can't expand, open, because they can't find the workers. Now, this is not magic. I mean, any fool would know you incentivize something, which is unemployment, you get more of it. So the federal government has financially incentivized unemployment, so you get more of it. So that said, again, I'm not arguing that the persons that receive it aren't entitled to it, but it is delaying the recovery that I thought would be a V-shaped, then a U-shaped, and now a Nike swoosh. So with that, I guess we can start questions, Sarah.
Well,
All right, let's start.
actually, can I talk about the pony a little bit?
Which pony is that? You have
That's
a
an old
pony?
joke.
Oh, you have a pony? I saw that Seinfeld episode where he, well, never mind. We won't get there. No, it's a long story.
You know, I'm looking at the data, and Ernie was talking about the markets, and Federal Reserve machinations may be creating distortions in how we would normally interpret information from the marketplace. Now, having said that, we have seen some generally positive evidence in the data over the last few weeks. We've seen that spread between corporate AAA bonds, very highly rated companies, and lesser quality BBB rated bonds move from about 140, 150 basis point spread down to, about 250 to 275 basis point spread down to about 140 yesterday. And that movement continues unabated over the last few days. For reference, March 4th, before all of this really hit the fan, the spread between AAA and BBB was 75 basis points. Then what we've seen as typical during the current administration is about 50 basis points to 100 basis points. So we're getting back down there, and I look at that very positive.
Scott, you're saying it widened, then it diminished.
It's diminishing.
So in other words, investors got really scared, and thus they got out of corporates, pushing up rates, and then got into treasuries pushing down rates. So that the yield widened to 2.5%, 250 basis points. Then you said now it's come back down, meaning they're getting more comfortable going into corporates and getting out of treasuries.
Right, willing to take on a little bit more risk.
Yeah, okay. Right.
Also, CCC rated bonds. Now, these are what we typically call junk bonds. CCC and lower, they peaked at about 19.89% or 84%, sorry, a few weeks ago, and they've come down 511 basis points during that period of time. So at least the credit markets are telling us that there's more appetite for risk out there.
But to argue against that, Scott, the Federal Reserve is buying some of those bonds.
Well, like I said, yeah, it's distorted.
Yeah, you did start out. So it's not necessarily investors getting more comfortable. It's the Federal Reserve getting more scared and buying these bonds that no one else will buy. I should say no one. They'll buy, but at a reduced price and a higher yield.
That's true. Now, but when we look at the claims data, now this is for the nation, typically during a recession, you'll see a peak. The peak of economic activity is going to occur when you see initial claims starting to move up. The first warning sign that maybe things are improving are when initial claims peak, but really the confirmation is going to be the peak of continuing claims. Now, the peak for initial claims occurred in late March when the coronavirus lockdowns really were starting to be put into place. And it's possible the peak in continuing claims has occurred, and that would be about mid-May. So that's basically peak to trough. We're going to have the probably one of the most severe downturns in GDP and a pretty significant recession, but it might, at least looking at the claims data, it suggests it's going to be one of the briefest recessions we've had. TSA is reporting an uptick, I think 39% as of this last Saturday in terms of passengers compared to a couple of weeks ago. We're seeing, well, this morning we saw a drawdown in oil inventories. We've also seen really a surge in motor vehicle gas supplies. There's a lot of what we would call green shoots out there to suggest we've gone past the trough in May. We may still see some downticks in June, but we've been through the worst, and now we're on the road to recovery.
A swoosh, no, a Nike swoosh. Scott won't sign on to that. I don't blame him. There
Well,
may be a lot.
I wasn't that good at geometry.
Yeah,
Um,
well, and it might be
my, my
might be a
classical,
violation of some sort of license agreement. I may have to pay Nike some money for using that term. I don't know.
and I'm a little slim on classical Greek, so. But
Okay.
I would offer that when Ernie was talking about the Nike swoosh, in terms of achieving or surpassing peak activity in the level of GDP, we probably are looking at the back half of next year. And in terms of significant improvement in labor markets, throw out, an unemployment rate of 4%, that's probably going to be the back half of 2023 or 2024.
Yeah. Sarah and Adam, questions there from the audience, our panel, or from the webinar
Yes, we have
participants?
some great questions coming in, and please, if you have a question, you can use the Q&A function on the Zoom toolbar at the bottom to submit your questions. We've got a good amount of time yet for questions. Some folks, particularly policymakers, are asking whether this analysis takes into account the recent Department of Revenue reports for state revenues that have come in, or the delay in the state income tax filing deadline, which has been pushed to July 15th. Does this report do that?
Yeah, that's a good point and a good question. It does not. And I have to warn against those revenue projections. I did see those. We did see those. And one of the problems is, according to the projections, state and local taxes, income taxes, corporate and individual, took a hit. Well, some of that hit was because of the delay in payments. So we did not, we looked at it, and it didn't refute any of our findings. Now, it didn't necessarily support our reduction in personal and corporate income taxes. It did. Scott, you want to talk about some of that? But we did look at it, and we didn't find anything that was inconsistent with our projections.
No, our projections are, we tried to do that slice of 56 days between March and May. The income tax, there might be some elements of withholding tax that might be involved there, but that's contemporaneous to the current conditions. A significant portion of that individual income tax that's reported by the Department of Revenue, that's going to be on earnings for the previous year.
Right. So so it's not going to line up with those projections. It's not going to line up with the actual payment of particularly corporate and personal income taxes.
Mm-hmm.
We got another question from a public policy maker in the legislature asking how much will these numbers change before session starts in July because the drop in revenue, like you were just talking about. How much well, this is kind of a loaded question, but how much do you believe the legislature will have to cut in the last 17 days? And that kind of plays off of another question we got earlier on, do you guys have any idea on the role the legislature should play, if any, in the recovery process? Some people have been talking about reducing regulations to spur private industry growth. Should they reduce taxes? Should they cut spending? And I know that's an open-ended can of worms, so go right ahead.
Yeah, and some of that has a lot to do with the CARES Act. In other words, we said in our caveats that some of this, like the support, and I would argue against some of the support that we're hearing arguing to diminish the impacts on some of the states, high spending states such as New York, the loudest person in the room. And then the second loudest, of course, is the governor of California, talking about the hole it's put in their budget. But to that, I think, and there's no way we can know, but again, we're counting on the award of money that doesn't exist. In other words, the federal government is going to send us money that is paper money in a sense. It's backed by somebody's future income, and that's luckily I'm a baby boomer, and I won't pay for all of it. Unfortunately, millennials and Gen Xers are going to be paying for it with, again, higher inflation, higher interest rates, and higher taxes. Now, regarding if I were a legislator, and that's we know the likelihood of that happening is quite quite low. Who would vote for an economist? Not me. Not me. But anyway, caution. Caution. You're going to have to dip into the reserves. I mean, I don't. If I remember, this may be not accurate. It's the reserves now are $400 to $500 million, I believe, in that range. So you're going to have to dip into those reserves. The real key is going to be at the local level, not so much at the state level. Now, for example, Scott, now I'm stepping where I probably shouldn't step, but at Creighton, we've taken some hits, believe me. I've taken a pay hit. I've taken other hits, and that's quite as it should be. Why should we be not part of the solution? But Scott teaches at UNO, which is what I can sort of speak to what's happening in Creighton. I cannot speak to what's happening at UNO, but there has to be some sort of, if the dry cleaning person is having to take a hit, I'm taking a hit. We in education have to take a hit. That's where the big money is in terms of at least some flexibility in state spending, and also at the local level. The idea that K through 12 can escape taking a hit is just not feasible. Now, one way they can not take a hit, of course, is keeping those assessment rates too high. The taxes only, the assessments actually, and we all know what happened in the good old go-go days. The assessments on agricultural land went up, up, and up as ag income went up and up and up. Well, now it's come down, ag land prices, but their taxes have not come down. So we need to see those at the local level, some sort of flexibility in terms of the assessments. That you cannot continue to hit those businesses, the farmers out there. We in education, whether it's post-secondary or K through 12, we've got to take our share of the hits. So in terms of spending, I would argue that the legislature needs to talk and at least indicate that you in education and across the board. Now, there's some areas you just can't cut. I mean, for example, the prison systems, Nebraska is as I understand it, I certainly can't comment with any expertise, that's not a place you can cut unless you want to turn some of these these individuals in prisons out. But Scott, you want to talk about any cuts in the state public higher ed or not?
Well, you know what I'm thinking about, and it goes back to the last webinar that when we met. We saw personal income in April surge 10.5% across the nation, and a lot of that has to do with the CARES Act. We've got a lot of money in the pipeline. It's other people's money, and like Margaret Thatcher said, eventually you run out of other people's money. I think it's time to redirect our attention from the demand side and start thinking about the supply side, and what can we do to encourage businesses that may be on the ropes to get back into the game. Encourage new businesses. Is a fantastic time to start a business. And to that end, what kind of regulations are out there that impede that type of business formation? Is it a permit issue? I mean, now this gets to some of the local level. Those are the things that we need to be looking at.
Right. And some of the COVID-19 regulations, I mean, it's perfect nonsense. For example, in Michigan, you go for a ride on a boat, you can only have 4 people. Now, if you and your family come there and you have 2 kids, does that mean you drove there in your car? Come on, for God's sake. Now you're going to leave 2 of the kids at the shore, go out in the lake and come back and get the other 2 and drop 2 off? I mean, where does this come from? Where does the governor get off telling people that you cannot drive from your home, your primary home, to your vacation home in the same state? What I mean, I'm talking about nonsense regulation, and there's been a lot of it regarding the COVID-19. And I think if you look at Nebraska, Nebraska's numbers are much better than what we're seeing in other parts of the nation. In other words, our public policy folks have taken a better approach to it. Now, maybe I might argue with some of the things, but we've done it. We've opened back up faster than some other states. And I would argue we need to open back up. In the end, we're going to have to open back up. Open businesses, the idea, public policy wise, that you can close down the economy and not just because of the COVID-19. We're going to have to take quarantine in some cases high risk individuals. Now that sounds bad, but it's better. It's a better option than not opening back up. And as I said in the last webinar, there were two economists might as well, I was going to say Hollywood, but they were actually at Harvard. And they argued for closing down the economy till 2022. Now, who in the heck could come up with any nonsense like that? We've got to open back up the economy. If we see, and we will see infection rates rise, we may see deaths rise, but that's something we're going to have to deal with, because we got individuals out there right now that are dying because of not getting mammograms, not getting colonoscopies, not getting their checkups, not getting their medications. We've got, so in terms of regulation, we've got to open the economy back up. And those of us who are over 60, we have to deal with it. We're higher risk, and and we have to accept that risk and maybe take extra precautions.
You know, I was looking at the national data from that personal income report, and the largest decline in dollar value, the category with the largest decline, was hospitals and outpatient services. That's what we're surrendering.
That's scary, because in our rural areas of Nebraska, these hospitals are central to economic development, and that is really a concern of mine, and a concern of everybody's, of closure of some of these rural hospitals where you're going to drive perhaps 50, 100, 150 miles for care. So we have to think about, in terms of public policy, about the support for the hospitals that have been hit much harder than other industries. That's a great point, Scott. Yeah.
Thank you both for your thoughts on that, gentlemen. We're going to move now to some questions related to unemployment insurance. Can you first give us some clarification? Actually, in both of these questions, I think people are looking for information because there's conflicting pieces of information out there about how the unemployment insurance program works. What labor is insured for unemployment? For example, are packing plant laborers insured? Are childcare workers insured? And then how do we square the widespread statement that the unemployment, particularly the pandemic unemployment insurance program, would discourage people from re-entering the workforce, with the fact that most people have heard that if you're declared ineligible, that you can't get unemployment insurance? So how do you square those things?
Yeah, well, I can, Scott's more knowledgeable in this than I, but I will say that self-employed, for example, do not qualify for unemployment insurance, but you can be unemployed. So if you're in a household and you're called by the U.S. Bureau of Labor Statistics, you're in the sample, you're part of the unemployed, but you're not part of the insured unemployed. Child care workers, if the child care provider pays into that plan, then you will be covered. Construction workers as well. Some industries that do not pay into it. Now, in academics, our institutions do not pay into the plan, but once I'm out of work, unemployed, I can draw unemployment insurance, but what happens is Creighton pays it to the public institution. They then pay it to me. Scott, you know more about this than I.
No, I think you hit that, and that's one of the things that the CARES Act covers. The CARES Act extends beyond covered unemployment, but it also includes independent contractors and the self-employed. So we'd have a bigger safety net there. The second part of your question, and I'm at a loss.
Sure. Well, the question is, the questioner says, I believe that unemployment insurance law requires the recipient to be declared ineligible if they're offered their job back. So why do experts keep insisting that the $600 a week federal bonus keeps people out of the UI program?
Yeah, I'm not familiar with that.
Well,
you know,
I think that's technically correct. That is correct. But I'll say it's not happening. I will say, and I have talked to, particularly I've talked to restaurants, and they have indicated that is happening. In other words, it's the implementation of the policy, and that person who asked that question it is correct. But I will promise you that is happening, and it is keeping people from going back to that same job. Now, there is the question about seeking other jobs. In other words, there is a requirement that you have to receive the unemployment benefits. You have to have looked for a job. So you could have the case where you've lost your job because of COVID-19, and the former employer is not asking you to come back, and you're looking for another job. Well, how vigorously do you look? That's another question. And I would argue, I just don't think, I'm positive as I sit here that it is reducing the incentive to get another job, and it is increasing unemployment, and it is, I won't say it's slowing economic growth, it's money in the system that those individuals have to spend. So there are some positive impacts. I'm not denying that. But again, who pays for that later on? Well, again, I won't repeat the three things that are going to be used to pay for it.
People respond to incentives, and the University of Chicago just put out a report that 68% of the people that are qualifying under that pandemic unemployment insurance program, 68% of them are getting more from the unemployment benefits than they got from their wage. And half of those folks, I'm sorry, 68% are getting more. Half of those folks are getting 34% more than what they were making. That's a strong incentive to work the system to stay unemployed.
And again, this is anecdotal. I've talked to friends that have talked to their employer and asking, well, maybe you could lay me off. And, of course, now the problem is that increases the experience rating of the employer. That's an issue. In other words, it will raise their taxes next year. But I think there are some of those as well that volunteer for unemployment, and it's collaboration. I mean, in other words, I'm not arguing that this is dishonest. Is it unethical? I don't know. That's not for me to judge. I can say with 100% certainty that a portion of the unemployed are there because of the $600 a week by the CARES Act. Now, how much? That's arguable. But the fact is, it is increasing unemployment.
So talking about unemployment, we did get a question targeted at Mr. Strain on, do you have any idea what the estimated job loss in Nebraska is going to be? We know the 93,000 that we put into the model, but like after the $600 from the CARES Act is exhausted, are there any indicators?
No, we haven't looked at that.
Okay.
But it will be. But that's a good point. In other words, we're at 92,000. We're assuming those jobs are not brought back until the end of the year. So that 10 billion plus loss is assuming we don't get those back. Now we will, as you say, I'm not saying we have to wait till August to get them back. We will get some of them back as the CARES Act, other portion of the CARES Act is implemented. So that job loss is going to come down. Mm-hmm. So the estimated impact is likely to be less than what we're estimating going forward. Now, that doesn't mean, of course, if we lock down the economy again, if the virus does reappear with a vengeance, then our numbers may be low.
Yeah, we did not directly bring in to the analysis any monies from the CARES Act. We viewed this that as the money comes to the state of Nebraska, that the labor market will reflect the inflow of that money to the state.
And I saw a question up here there. The CARES Act, the unemployment portion of the CARES Act ends at the end of August. So that is correct. But the CARES Act, the impacts are going to continue. There will be CARES Act 2.0 or 3.0. I mean, the House has come up with another package. Now, it wasn't passed by the Senate, and it didn't go to the president, of another $3 trillion. Now, to put that in numbers that we can understand, that's more at the level of the street, $3.1 trillion. That's larger than the deficit. That would increase the deficit to something like $5 trillion, $5 to $6 trillion. And the deficit is the debt is already larger than the economy. I expect the federal debt to grow to be 150% of the U.S. economy. So that's a real concern. There's again, the impacts will be higher interest rates, higher inflation, or higher taxes. And
well, on that subject of higher taxes, how do you think that the unemployment insurance claims, which are at a historic level, are going to affect the employer unemployment insurance taxes that they're going to pay in the long term? Will it be a significant increase, or will it ultimately have an effect on the demand for labor?
I think it will, but that's more of a administrative issue. The experience rating of employers, for example, if you're in construction, they pay a higher unemployment insurance tax each month than an educational institution where we have a more steady and stable workforce. So the CARES Act, which that money, the $600, is coming from the federal government. The other portion, of course, comes from the state fund. Now, will the state fund run out of money? That's another issue. And of course, that's likely to raise the tax rate for all employers across the state next year. So the fund is going to be diminished even with the $600. Scott, do you want to add anything to that?
No, I think you hit what I was going to say.
We have another question. Economically speaking, which states, in your opinion, have approached the pandemic the best, and what can we learn from them now and in the future? And I know we're talking about Nebraska here, but I think for the future, if Nebraska wants to learn from another state.
Well, if I could just preface this a little bit, Nebraska is one of 6 states that have achieved a decline in continuing claims for 3 consecutive weeks. There's only 6 states: Kentucky, Montana, Ohio, Vermont, and Wisconsin were the other 5. That to me is an indicator that those states have done something or are doing something that we can emulate.
Yeah, and one thing that Nebraska has to be very vigilant about is 20 meatpacking plants have been closed over the last several months and reopened, and we've had those with a different production line arrangement. Now, what that's meant is the farmer has been hit hard because of the lack of demand from the food processors, but then the consumer is paying higher prices. So the farmer is seeing higher and higher meat prices at the consumer level, for example, but lower and lower prices at the farmer's level. So we're seeing that. So Nebraska does have an especially significant exposure to COVID-19, and that exposure is through meatpacking, it's through food production, but also through agriculture, in the sense that some of our trading partners, for example, China, Vietnam, Japan, their economic expansion, the agricultural sector in Nebraska depends heavily on their demand and increasing demand. So as far as handling it, I'm sorry to say it's somewhat what we economists call exogenous to the public policy makers, but something I think if I were in the legislature, I'd be very concerned about how you address meatpacking plants and how that's handled, because you could, if you don't do something about it internally, the solution will be provided by the federal government, and that would not be a good solution. So that's something we need to be especially vigilant on, is what do public policymakers do in regard to meatpacking and other food processing, not just meatpacking.
And kind of to pivot off that, and I want to be respectful of everybody's time, so this will be the last question, unless you answer it super quick. So because we know that ag revenues are definitely going to be negatively impacted, what does that mean for states like Nebraska that are heavily dependent on agriculture during the recovery? What options do you see, especially in the rural areas of the state, in the recovery side of this?
Well, as most listeners know, there's a $16 billion support plan coming from USDA. Okay, that's $16 billion this year. The last 2 years, that 18 and 19, there was $28 billion. So how does $16 billion fit in? Now that's $16 billion for nationally. Now what does that mean? Well, that's about 1/5 or 1/6 of net farm income. So that's going to be to provide some support. But the real issue for a farmer, one of the issues for the farmer, and that's up to in public policy, is property taxes. How is that handled? Because now the property taxes, for example, for a bushel of corn is much higher in Nebraska than Kansas, much higher in Nebraska than Iowa. Likewise, South Dakota. That has to be addressed, and that has to be done through some state aid to education, whereby several school districts, very few, are getting the lion's share of the money. But agriculture is going to be hurt and continuing, but it's going to be much like other industries because of the $16 billion that comes forth from USDA and the PPP, Paycheck Protection Plan. Some of that money went to agriculture as well. Not much, but some of it. Scott, do you want to comment on that?
I was gonna chime in on the property tax relief. I think that's a big issue.
Yeah, I mean, it's. There's frustration at the farmer level. The farmer supports the public schools, but how much can that farmer support the schools and go out of business? Now, what we're seeing in Nebraska, here's another long-term public policy issue for Nebraska legislators, is the fewer and fewer farms. In other words, we're seeing defaults in farms. Nebraska is second or third in the nation in terms of numbers. In 2019, or up through first quarter of 2020. Okay, now larger farms are buying up smaller farms, which means, of course, fewer and fewer farm families, and you're talking about less and less support for the public schools in the local areas. So somehow that has to be addressed, and that's been going on since there's nobody on this webinar that can remember the 1930, at least I wasn't there. Scott might have been there, I don't know. No, Scott's a younger man than I, and you can tell that. But nonetheless, 1930 has been a problem. Nebraska is not necessarily provided a long-term solution, and it means a battle, I will call it a battle, between the urban schools and some of the rural schools.
Well, thank you, gentlemen. I think that's all the time we're going to have for today. I want to thank Ernie Goss and Scott Strain for being our guests, and Sarah Curry for helping me facilitate this conversation. We're very grateful for all of your questions and attendance. When you're done with today's program and you log off, you're going to have an opportunity to fill out a survey about today's webinar. We'd love your feedback and thoughts so that we can continue to improve these programs. And of course, you'll be able to check out the recording of this webinar later at plattinstitute.org/podcasts, along with all of our previous programs as well. So we thank you for attending. We'll look forward to having you in our July programs about the return of the Nebraska Legislature. And we hope you have a great day. Thanks again, everyone.